Good evening, ladies and gentlemen. This is Clueless 8, and this is the second video cast I'm doing tonight on sharing some observations on markets and technicals and all that stuff that I'm trying to analyze. Let's get straight to what I'm seeing out here. A couple of things I want to point out tonight on the internals of the guts of the market, as I like to call it. Externals are simply the charts, the manifestation of what people are doing, obviously, what machines are doing. But the internals are also showing what some of the so-called smart money, or what's happening underneath the surface. So saying all that, this is close to a weekly chart that I can show you going back to 2012 April, and now we're at 2016, so almost 5 years. I'm sorry, almost 4 years. So on a weekly basis, pretty much we can see that we are in a short-term bottoming process here. You can clearly see what's going on with, I'm going to start off with the stochastics first. And you can clearly see here that we are at levels which generally portends a sharp retracement reflex bounce. So you can see that here, right? Back in May of 2012. You saw that here around November, December of 2012. And every single time, I'm just pointing out a few of them. And then the lows of October 2014, which talked about quite a bit right now. We're pretty much at those levels. We actually went below those levels last Wednesday and bounced hard. I want to repeat to everyone that we rallied 700 points on the Dow, 100 plus points on the S&P 500. It's only natural that we pull back a little bit. I mean, it doesn't take a rocket scientist to figure that out, right? So this was the October 2014 lows. Down here again, below 20 on the RSI. The very reliable indicator, very reliable tactical indicator. Simple as that. None of us know what's going to happen 6 months from now or 3 months from now. All I know is what I expect to see over the short term, which the next couple of weeks, maybe a month or so. That's it. So, and things change. Like I said, I'm probably one of the fastest readers of the market. I'll let people know and let them do what they need to do. Use my work as a very effective tool to enhance your own portfolios. That's the way I look at it. This is not financial advice. I am not your broker. I'm simply somebody who's sharing my observations and thoughts on the market. Obviously, I've done more right things than wrong. That's why you're listening to this. Now, saying that, look at what's going on now. Okay? That's pretty big stuff. So even a small move over the 20 level on the RSI means that we should get to somewhere, on the Dow Jones at least, towards the level of the mid 16,000s. Is it possible? Absolutely. Is it also possible that we stay below the 20 for a period of time? Well, the period of time doesn't normally last. I'm looking back at history for months and months. It could last for another week, 2 weeks, but I'm talking it's going to happen. The power bounce is going to happen, and that power bounce should take us. And I drew these channels for people to understand. And if you see that, it hit the channel, tried to enter it right there. That green candle got rejected. It could fall another 200-300 points, no question about it. This is a long-term uptrend line, support line, if you want to look at it that way, from 2012. It's possible that we test these lows again. But one way or the other, looking at what I'm seeing here, we should expand this a little bit. Notice how it went here, right? That was today. That was actually Friday, and then the pullback today, the reversal hammer. But looking at what's happening here, I don't want to get into it too much, but all I'm saying is that this is similar to this volatility cluster, like I explained in the past video cast, and we can expect to see, it's matching these points here, we can expect to see somewhere around this level, which is roughly about 500 points from here. 500 points? Well, you better catch a good portion of it, I'll tell you that, okay? Saying all that, nothing goes endlessly down. We were down here. We went down as low of 5.48. We closed somewhere around 9 here. Okay, at 16, we're still below. And every single time, you get a retracement bounce. That's it. All right. Let me show you one other thing here. Let's go back to the daily. Look at the daily charts on the Dow Jones. I'm going to switch into the S&P 500 in a second. You can see what's going on. This is a daily chart. You can clearly see we're over the 20. And despite today's fallout on the Dow Jones, on the markets, right? And the rejection here at the lower channel, right there, right there. And these channels were drawn, by the way, not today. They were drawn last week and even earlier. You can clearly see here there's a positive divergence in the works. This arrow simply means we get overbought. This means we're oversold. And of course, we got oversold. We actually got oversold, believe it or not, at the lowest point on when the market was at 16,347. So there was a positive divergence building that built into a massive 700-point rally in the markets, which most people didn't even capitalize on. That's the sad part of the story. And I showed these positive divergences, said this was coming, and that's exactly what's going on now. So despite today's fallout, look at this bearish engulfing. The internals are still suggesting higher. Another thing that I noticed today as I was doing my work prior to the video cast is the Compq curve. Want to know what the Compq curve is? Go to Investopedia, look at it, read it. It's a good swing indicator. And the Compq, I noticed, is coming off some extreme low levels of around minus 16. Now, during the crash of August 24th, which was big, the Compq got down to a low of minus 13. So saying all that, if the Compq just simply moves up a little bit, as it's starting to do that, okay, a little hockey stick bottom, you should expect to see the market come up roughly to this congestion zone here. That's a congestion zone right there of around 16,500 to 16,600 right there. So my thesis is that we do this type of move in between little volatility moves here, obviously. And we could test these lows also, no question about it. We move up to this level, and at that point, we see what happens. This volatility zone here on the S&P, on the Dow Jones, is exactly what we're going through here on the current, currently. Let's take a look at the S&P 500. Same story. This is the daily. This chart's been around for a while for people who actually spend some time looking at charts and not just trading, with the demons in their little head, but actually playing tactical bounces, tactical breakdowns, all that good stuff, and doing well. And just to remind people, last week was a great week. And I'm not talking about the Wednesday rally. I'm talking overall. So again, I don't want to get into it too much. So bottom line is the S&P, you look at the STOs still moving up. We had a on the E-minis, we had a inside day. On the S&P, it looks like it's a bearish engulfing. But a bearish engulfing generally is when you open higher and then close lower. This one didn't really open higher. It was still lower than where we closed, lower than the highs of Friday. So saying all that, looking at this picture here, this stayed intact. It's telling you something. Don't always let the prices fool you. I've been saying this for years now. And some of you get it, and a lot of you don't get it. So if you want to get it, then use this as some effective tools. Compq, let's move on. Again, starting to bounce. Last time we were down here was during the flash crash, right? Right there. And the subsequent days after that. First week in September. Look at that. What happened after that? We went up hard. We had a reversal. That was a Fed reversal, the Fed fake out, as I like to call it, right there on the 17th of September. We pulled back hard, tested these lows, but what happened to the Compq? It stayed higher. That's called a positive divergence. You can make these things up. These are real. So what it was telling you on the crystal ball, people ask the crystal ball. Well, this is your crystal ball, these charts. And you can see them yourself. The positive version was telling you that the market was going to make a big move. Now, this was a big move. Here, similar type of patterns developing. I don't know if it's going to do this. No one knows. There are some fundamental problems out there which are pretty serious. The Chinese debt situation and overall with oil controlling the markets, like I'm not going to get there. I mean, that's just wild. Obviously, is a different set of criteria that's driving the market fallout this time, but still, you see what's going on. Just purely looking at technicals, cutting all the noise out. So these have to be taken into account. The other thing I just want to mention, which I've mentioned many times, is that the standard deviation from the 50 and the 34-day moving average is quite large here. It's almost -9. Here, it was actually bigger than this time. Now that you think about it, this was probably -10. That means things got really, really oversold. This was like a -9. And you got a big reversal bounce, the volatility cluster, another retest and takeoff. This was a -10, if not a -11, for all I know. Just by looking at it visually, look at the distance traveled away from the moving average. Now, when you have a standard deviation of -10 or anything like that, what do you have? You get a mean reversion. Let's see if that happens. Running out of time here, so I want to show this quickly. The other thing I noticed here is the extreme of the vortex indicators, right? So look at the vortex indicators. The red line starting to come down. The green line starting to go up. So all these are indicating on a swing front that we're going to have a big pop on a short-term sustained basis, probably as we get into February. Okay, that's really what it's telling you. And let's take a look at the NASDAQ, where a lot of the stocks that we play reside. Same story. You're starting to see same story, positive divergence. Vortex indicator starting to come down. Mr. Compq curling up, just the way it did here off the August 4th. So it's kind of telling you, if you want to read the crystal ball, that tech earnings are really not going to be as bad as they make it out to be. Doesn't mean there's not going to be volatility. It just simply, is giving an early morning indicator. Now, if we break below the 4,300 level, then everything changes. But nothing just goes down forever. We're putting tactical bounces. That's all I care about. Take a look at the Russell 2000. Same story. Despite the drop in oil today, it stayed on the dailies. Okay. Same thing here. Let's take a quick peek at the Compq. Same thing there. So, or at least on a swing basis, telling you that at one point there's going to be a little stabilization, short term, and that's going to be what we've been playing on. Played the 700-point rally. Let's play the next 500 points. How about that? Stop being dogmatic. Don't get too giddy when markets are up 300, 400 points. Always have hedges and do what we are doing. Thank you for your support. This is Clueless Safe Trading. and review every single chart